Good Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group. Financial Resources Group is out of Glastonbury, Connecticut. You can find them online at www.frplan. That's F as in Frank, frplan.com. More importantly, you can call them, schedule your no-obligation consultation, 860-657-8380. One more time, 860-657-8380. And I'll repeat those points of contact at least a couple more times before the end of the show. Just a couple of things. I know Mark wants to give you a disclaimer as well. Because of the upcoming Easter weekend, we have Good Friday and Easter on Sunday. We are pre-recording this show. Today is actually the day that we're recording this show is today is Wednesday. It's April Fool's Day, April 1st. So I just wanted to mention that to you, not to bring people into the. I know you, Mark. I know you celebrate Easter. You got a big weekend coming up. Great to see you, by the way. Good morning.
Yeah, thank you. It's great to be here. And
you want to do your disclaimer now so that you don't forget later on, or?
Yeah, I would say that please understand any advice that you hear today is not investment advice. Financial Resources Group LLC is a registered investment advisor and acts in a fiduciary. Is a fiduciary. Please don't take any advice that we're giving you today. Act on your own. Find a licensed professional, and the past performance is not indicative of any future results. So please be cautious about what you see and read. But again, do not construe or misconstrue any of this as investment advice. And if you do have any questions, give a call to 860-657-8380 or find us on the web, www.frplan.com, for additional disclosures.
There we go. All right. Great to see you this morning. How are you?
Yeah, feeling good, re-energized, got a lot of energy. In the midst of tax season, it's extremely busy, and meeting and seeing a lot of different people, and
now that we're in April, there's only a couple more weeks of tax season.
Couple more weeks, so the phones are ringing, and we're just trying to get things finished up, and people getting their last minute bits and pieces. But we have a much bigger show to talk, bigger picture to talk about. And the next time, I definitely want to dig into some tax strategies.
Good.
For people looking forward to 2026, because 2025 was a great year, and we were able to save people heaps of money. That were able, bundles of money, real serious savings for those who are willing to listen. And they're very happy this tax season. So I want to get more and more people into my tax strategy business as well, as it pertains to Roth conversion. So that's a preview of the next show.
That's huge. That's great. And how timely would that be for next week?
Very
All right,
timely.
Let's start at the top, because you simply cannot talk about markets right now without addressing what's happening in the Middle East. Mark, for people who are trying to, kind of keep up with it, can you give us maybe a little bit of a check on the U.S.-Iran conflict and what the market implications are right now?
Yeah, Gary. I mean, it's really interesting. Obviously, this began on February 28th. It was a joint strike between the United States and Israel. I'm sure everybody knows most of that, in the nuclear assets potential. There was just a lot of things a lot of good reasons for going in there. And I think there's a much more strategic reason as well, and the reason, obviously, to secure the Middle East and make it a little bit more peaceful place. But also, I think in the big picture, when you look at the end game, I think it puts us in a much better position to negotiate with China on trade, ultimately, because China's been buying their oil from Iran at $20 below the market, and they've been refining it very profitably. And without Iran, they're not able to do that, and that puts the United States in a much stronger negotiating position. So I think there's more to the story here from a strategic standpoint, and it started with Venezuela, and it's Iran, and now we're going to be, maybe dealing with China at some point. But it's an interesting thing. I mean, obviously the markets have not liked it. Oil, shooting up to $100 a barrel. You have things like inflation fears, and how quickly does that cycle through to the supply chain. And already we're seeing people posting on Facebook, these ridiculous gas prices all over the country. But at the end of the day, there's been some pretty good breaking developments, as you saw The markets on Tuesday had a big rally.
That's right.
With Trump saying this is going to end in 3 weeks or so. And he'll be speaking tonight. So today's Wednesday.
Yeah, which I find interesting because when you had contacted me saying you couldn't make it in because it was Easter weekend and you're going to be away, you couldn't be here, but you still wanted to do the show. And we came up with today, Wednesday, April 1st. We didn't know at that point in time that the president was actually going to be speaking Wednesday night tonight.
Yeah.
And I know when people are listening to this on Saturday morning,
he's
already spoken. That's right. But we're doing this.
Well,
we're recording this on Wednesday morning, so he hasn't spoken yet. That being said, today, April 1st, Mark, where do things stand right now?
Well, the point is, at this point, if he's willing to talk tonight, anything that he's going to say has already probably been released. So here's the deal. And it's a highly fluid situation, unfortunately. But President Trump has said publicly he believes the U.S. could be done with its military campaign in Iran within 2 to 3 weeks. Iran, for its part, has also, pushed back hard on the timeline. And their foreign minister, Abbas, I can't even pronounce it, Araghchi or Araghchi,
right, yeah.
went on Al Jazeera this week, and he said Iran is prepared for at least 6 months of conflict and that they will fight by any means necessary. So there's a wide gap between those two positions. But I would also caution everybody, there's a lot of noise in the market. There's a lot of back and forth, and you have two, guerrillas on one side beating each other's chests across from each other. That's really what you have. So, all this talk is great, but I don't think the Iranians really have much left to stand on other than their drones. And that's been an interesting shift in military technology. If you've ever studied military technology, we'll have a war and all our planes will get shot down, and then all of a sudden we come up with a plane to shoot their planes down, and now we have these drones everywhere for $20,000 that can. And they're actually making those attacks. I was a little nervous last night when I woke up. They're attacking the UAE. They're attacking Kuwait. They're attacking Saudi Arabia. So they're going after these targets with these drones, and I think they're desperate at this point, Gary. But it's hard to say. I'm not with the CIA.
So tell us about the Strait of Hormuz, because look, I know that's been a major factor for energy prices as well as global trade, for that matter.
Yeah, I mean, the Strait of Hormuz is essentially the jugular vein of global energy supply. So any disruption there, just causes all sorts of havoc. And again, here's another great example about what we went through with COVID, with China being our biggest manufacturer for all our goods and services when it shut down. Wouldn't it make sense to have some more diversification of oil and ports and shipping and energy, outside of the Strait of Hormuz? Because all it takes is one bad actor like Iran, and look what it's doing. It's holding the world hostage. So I think, I think about a fifth of the world's oil and liquefied natural gas actually passes through that narrow waterway between Iran and the Arabian Peninsula. So Iran has effectively closed its commercial shipping since the start of the conflict. They're using mines and explosive drones and other things to, ships need clearance, and unfortunately, they need the clearance of the Revolutionary Guard Corps. And, the result has been a dramatic surge in oil prices as a result. So, they're holding strong in that position. And I think ultimately the goal is to have all the Arab countries come together and actually collectively put their resources together to get that thing open. You need to open the Strait of Hormuz. That is the number one barrier. That's why the markets have sold off. That's why oil has surged. That's what's hurting the economy. Now, any bright spot, and Trump saying that the conflict can end and hopefully the Strait of Hormuz can open up again. I know they let some Pakistani ships through the other day. So there's some bright spots. But again, there's a conflict. It's going to be a negotiation, and let's see what they decide. But ultimately, let's hope that the Strait of Hormuz opens, and the diplomats and everybody who is involved in these negotiations can come to terms that we need to open this up. That it's not a good thing to have it closed.
So what's Trump's position on that?
Well, Trump seemed to throw cold water on the idea earlier this week, and he told allies essentially he wanted them to handle it themselves and go get your own oil. But but he's been frustrated with NATO. And NATO hasn't done anything to step up, and he's called that out multiple times to say that NATO is really not a fan of, not an ally of ours as much as they say they are. They're not stepping up at all. And the bottom line is for investors, Gary, as long as the Strait of Hormuz is closed or restricted, we have elevated oil prices. That means potential for inflation risk. That means, meaningful pressure on corporate earnings. And the good news is that the market did get some hope on Tuesday that a resolution will be near, and we saw a major, major jump in the markets. So,
well, all right. So let's get into that Tuesday rally because it was quite a day. Tell us. Maybe kind of walk us through what happened on March 31st.
Well, I mean, it was the best day since May of last year, and a genuine relief. It's what they call a relief rally. So a relief rally is when the market is really sold off sharply due to an exogenous shock or fears or bear market corrections, whatever. We maybe got close to bear market. We didn't get anywhere close to bear market. Bear market's 20% negative. We were close to 10% negative on the NASDAQ, close on the S&P, on the S&P 500, but never really. Market's been extremely resilient, and it's amazing to see that we were only down 10%. And I mean, if this were to continue, I think the downtrend would continue as well. But this rebound is huge because you have these people called short sellers who are betting against the market when it gets bearish. Who now, when you get good news, need to buy back the shares that they're betting against. They borrow against the stock to short it, and now they have to buy it back to cover their position. So that's what they call a relief rally. You see a lot of short covering and people bailing out on their trades to go long again, at least in the short run. At least they're taking profits. So you usually on a relief rally, you get a big up day, then the next day it's slightly up to down. It bounces around. You have a lot of volatility as a result of that, So you got to be careful not to get whipsawed and ultimately, be diversified like we are and stay the course, not, try and buy the dip and sell it. That's how you get hurt. You get whipsawed, and even in professional investors get hurt in those environments. So you have to be so careful. But,
so, I mean, what are you saying here?
Well, basically, the S&P 500 gained 2.91%, closing at just above 6,500. The NASDAQ jumped 3.83%, which is a huge day, led by technology names. And the Dow Jones Industrial Average surged 1,125 points, or 2.49%, closing at 46,341. So that's a big, big day. Even the small caps, Gary. The small caps are the Russell 2000. Remember I talked about the small cap companies?
Right. Yep.
They were in the news. And international equities also responded very positively. So this is obviously it's very obvious. Everyone wants this war to end. They want the oil to start flowing. They want the economy to get back to normal. And it's again, it's going to be difficult, but I think we're going to get there.
So, if I'm hearing you right, does this mean that the worst is over?
Well, no, it's just a relief rally for the short run, Gary. It's not a confirmation that the conflict is resolved in any way. We'll see what Trump says tonight. Hopefully, when you're listening to this on Saturday, we get some good news, right?
Yeah, just to reiterate, we're recording this on Wednesday morning.
Recording it on Wednesday due to the Easter weekend. So Iran launched 3 waves of ballistic missiles at Israel. And then, despite the rally, all 3 major U.S. indices still closed the first quarter in negative territory. So the NASDAQ was down 7% for the quarter, the S&P dropped 4.6%, and the Dow fell 3.6%. And as I said, it was down further than that. A lot of, a lot of people are very nervous about the market, and, just because of the war. But all right. I think that's... I think the fears are overblown.
Really?
I think they're going to get the Strait of Hormuz opened up.
I do too. Let's talk about the investment landscape in first quarter's over as of the 31st of March. Wall Street Journal, they ran an article actually today, as we keep mentioning, today we're recording this, pre-recording it on Wednesday, April 1st. The article was titled, "Here's What Worked During a Rough Quarter for Markets." Okay, so what did work, Mark?
Well, Gary, I'm excited. I'll say that our model portfolio worked. And we weren't even, I didn't even show you this. I'm not even going to talk about the 60-40 numbers where you have the stock and bond mix. But we had a great first quarter relative to the market. So what was really interesting is in the Q4 timeframe, which is the September to December 31st timeframe, we had positioned our portfolio, and it was an end of year. We had a great year last year. All the reports I'm pulling beat the S&P 500. And again, we were anti-Mag 7. We started diversifying away. So we caught the beginning of that great rotation I talked about a few weeks ago.
Right.
So what did work, and we stayed with the model. We didn't change anything in the equity portfolio because we felt that we were very well positioned. Next quarter, I will be making some changes in the portfolio. Very, very minimal changes. And one being a move into emerging markets. I think this sell-off has been a gift. So I like a little bit of money into emerging markets, and I'm going to beef up my international just a little bit. But those are the only two minor changes. And we send out a notice to all our clients with a note as to why we made the changes. But last quarter we made no changes, so Q1 no changes. And sometimes doing nothing's the hardest thing to do because you read the news and say, "Oh, let me chase this, let me chase that."
Right.
The best thing to do is to take a deep breath. Be patient. Don't listen to that, your buddy's tip on the golf course, with some 5-letter penny stock. You want to make sure that you're buying the right stuff. So basically, Gary, energy was a huge tailwind for us. So we did very, very well with energy. And you look at all across the board, we have a global energy fund that just had a bang-up quarter. It was doing well before Iran because of the data center build-out. But Iran, obviously, with energy prices going up, it took the fund up as well. We also saw consumer staples, healthcare, which if you look at all the new jobs being created, a lot of it's in healthcare. Much of it is in-home care as well because people want to be cared for in their house. Mm-hmm. So we're seeing a lot of job growth there. I just did a interview, a seminar, an educational seminar on long-term care and long-term care costs in Connecticut at the Rocky Hill Senior Center, which I was so grateful to have. I had a room of 27 people, and a lot of the people already had policies, but they had questions on their policies, and their guys retired. So it really went well, and people really liked it. It was all about information, not about selling things, and it really worked out well. But in-home healthcare was definitely a big concern, and utilities also to some extent. So we were, again, shifting away, and despite what happened in the markets, we didn't feel that downward pressure like a lot of people did. And I think our worst day was down, including fees, by the way. I think the worst day, I ran a report that was end of day Monday, right? So that would have been April 30th. No. The 3rd, March 30th. March 30th, the worst I saw at an all equity was like minus 194 with his fee. So that's not bad given everyone else at that time was down 7 or 8%. So we've been trending about 5% above the S&P because of those moves that we've made. And again, those aren't exact numbers, but we've definitely been outperforming, and that's a good thing for our clients. So when I'm seeing them and saying, "Hey, have you opened your statements lately?" Like, "Oh, I don't want to look. I go, "No, please open them." And they're like, "Oh, wow, that's actually not so bad." So, again, those are things that we prepared for and we were in position for. We did not predict the Iranian conflict, but we did predict where we wanted to be for the longer term, and that's why we've done so well. So we're protecting our clients' money at the same time.
All right, so let me just do this really quick. I have a quick question for you as well. Folks, you are listening to On the Mark, along with Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group in Glastonbury. You can find them online at frplan.com and at 860-657-8380. I'll repeat more of that towards the end of the show. All right, this is pretty good news.
And let me mention one other thing too. We kept our inflation hedge on because we're strong believers that the rate cuts that people were expecting weren't going to happen. I didn't think Powell was going to do much into his new term. Plus, you looked at the economy, and it really didn't dictate much for rate cuts at this stage. But moreover, also materials and industrials also held up reasonably well. And these are companies that were obviously defense spending and domestic infrastructure. Given that elevated geopolitical risk, defense contractors have been a natural beneficiary of that. So we had exposure there. So, that really, really helped us out. And sometimes, I even surprised myself, to be honest.
So I'm hearing a lot of good things here, but
we got to talk about the bad part.
What hurt the most? Yeah, that's where I was going next.
Let's talk about the cons now.
Okay.
So what hurt was technology and growth stocks. They fell under the most pressure. The Magnificent Seven, your mega cap tech companies, had a difficult quarter, but that was also in the being built out. What used to be a software company, we used to be a database company, we used to be a cloud computing company, now is an infrastructure play because they're building these giant data centers everywhere. Okay, so you have to understand that now they have a huge capital expenditure to, they have to finance these things. A lot of it's off balance sheet. We'll get to that in another segment. Meaning that they're borrowing and with these special purpose vehicles and these different entities and these different structures they're using to finance these. It's not a direct loan from Facebook. It's an off balance sheet deal with all the private lenders. So there's a lot going on behind the scenes, but people are going to question how capital intensive is this going to be? When's the build out going to finally be profitable? So there's a lot of questions that are still unanswered, and that really hurt a lot of these companies. But conversely, these companies are so profitable, have so much cash flow, like Meta, even Oracle for that matter, who unfortunately is laying off 30,000 people. That's a big layoff. Anybody, by the way, if you're an Oracle employee, give us a call at 860-657-8380. We're and at www.frplan.com. If you work for Oracle, we actually I specialize in I got my start in this industry, my second start in this industry in 08 and 09, and all I did was work with severance packages, different pension plans, different cash balance plans, different benefits, and I made sure that everybody who was laid off can bridge themselves into Social Security and retirement. So we're really good at doing that. And I got my teeth cut in 2008 after. Everybody got laid off then. There was no shortage of people to help. So if you're affected by a layoff, I definitely would love you to call me because we can help you plan it out and make it so you don't dip into the wrong savings and everything else. So that's just an off topic.
I thought you mentioned oil prices were up like 50%, but I've also been hearing that there's some reason to think that oil could actually go back down. So is there a cross current? Explain this a little bit here for me.
Okay, well, one other thing I wanted to also mention that Microsoft also had its worst quarterly performance since the 2008 financial crisis, and their shares are down roughly 23% since the first quarter began. So I wanted to touch on that. But oil, so you mentioned oil prices up 50%. That's obviously a shock to the economy. It's a shock to people who are driving vehicles. It's a big shock to anybody. And, the markets are not prepared for that. And if you look at like Brent crude, for example, went above $110 a barrel at one point. We haven't seen that since 2007. Remember when it's like 150 a barrel?
Right. Oh.
Remember how that happened? And people who are on fixed incomes, people who are not making big money or working 2 part-time jobs, that has a huge impact on them. I remember back in 08, I knew the guy next door to my tax office owned a clothing store. I said, how's business? He goes, not good. I go, why? He goes, people don't have disposable income. I go, why is that? He goes, well, the $20 or $30 they would spend on a hoodie here is now gone into the gas tank. So, it has a real impact, especially on, let's say, the bottom half of the economy. So it's very tough. And then, it's just food prices go up and, it's just a whole, how do you want to put it?
Everything relies on oil.
Yeah.
Everything.
And we're still very dependent on oil, and it's going to be a long time before solar panels take over. And that we're fighting that now. So
let's turn to something that maybe I think people are really curious about. The market is pulled back, right? So are there any bargains to be found? Where should investors be looking right now?
Well, I know there's a lot of people who own NVIDIA.
Right.
I would, again, if you're diversified, NVIDIA is already 7.5% of the S&P 500. So stock has been struggling. I think what's going to happen with NVIDIA is going to be very similar to what happened with Apple. Apple got to be a $100 billion company, and it was just so big that, there was really no more room for it to go up in terms of institutional ownership, because institutional ownerships are restricted to you can only own a certain percentage. So my big feeling is what happens is, a lot of people don't realize NVIDIA is also a software company. You can't do AI without NVIDIA. And I think what's going to happen, you're going to see some value unlocked with NVIDIA now that all these big announcements have come out about, we're building more chip factories and we're building more factories for AI. But the company is just in a very, very good position. The PE over the last decade was closer to 54 times earnings, which has also come down to 33.5. So, the fundamentals on NVIDIA look really good. I would also say, I would be looking to pick through some wreckage in the software space, but just make sure that these are software companies that are reinvesting in themselves and they're not going to be fully disrupted by Claude Anthropic.
Let me
I think it's a little scary.
I got one final question for you, and I'm really running out of time. So you mentioned the Magnificent Seven. They've been taking a hit. I mean, are there other names that look interesting at current valuations?
Well, it's an interesting one. I would say, Apple is another one that I think could be quite meta, and Facebook could be quite interesting. But they're also in the process of cutting their workforce and downsizing. So the last time they did that, you saw great performance after they cut back on the metaverse. They right-sized the company. And also, I'm thinking Apple. Apple has been kind of sitting back, watching and waiting, and that's just how they do things. But Apple has Siri, so maybe, they were talking today that if they can get Siri to become like its new AI chatbot and improve Siri, then that would be a value unlock for Apple. But I think Apple looks very attractive here, and it's actually done fairly well.
What about Oracle?
Well, Oracle's doing a lot of cutting, and there's a lot of debt. They're on the hook for a lot of debt for their data centers. So they've been doing a lot of spending. It's had an impact on the stock, which is why they're letting 18% of its global workforce go in an email. That's really nice of them. So, but I mean, here they have $455 billion in remaining performance obligations to OpenAI. So it's kind of OpenAI is $300 billion. Excuse me, that's $455 billion in total. So that's having some issues. They'll also be raising $50 billion in debt. Oracle's a hold, in my opinion, not a sell, but it's a hold. So I'd be very careful. I don't want to go Jim Cramer over here. So.
All right, I got 30 seconds. What about just buying the index itself?
Yeah, I mean, I like the index. I think if you look at the performance of our portfolio, and you would want to look at the equal weighted index, so not the S&P 500 standard index. You want to look at equal weight. Equal weight is starting to outperform. And it's actually done a lot better than the regular S&P. So equal weight, the Dow is equally weighted, 500 companies, and each company owns the same percentage. And it allows you to get deeper into the S&P and find those winners before they become the biggest components. So
all right.
I like that.
Folks, you've been listening to On the Mark, along with Mark Papa. I'm Gary Byron. He's very easy to reach. He's got an office right here in Glastonbury, Connecticut, Financial Resources Group. You can find him online at www.frplan.com. And you can call him and meet with him at 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.